Welcome to the Probate Nation. Our show today focuses on reverse mortgages. Reverse mortgages have been around for many years. I recall first learning about them in the late 70s when I started practicing law. Over the years, we have been presented with issues in dealing with reverse mortgages, both for seniors while living and then in the administration of their estates. But this type of mortgage option has undergone significant changes in recent years. And we want to spend some time looking at those changes from two perspectives. First, if you are serving as a conservator or guardian of property and holding real estate, that real estate may be a key resource of income to support the person you are helping. Given that so many seniors want to age in place, this may allow them to do so even with limited resources and income for a bit longer before the house needs to be sold. Understanding reverse mortgage options, how to qualify, what you need to pay and not pay are but a few of the key points you need to know. Second, on the death of the senior citizen, her executor or personal representative takes over and is in charge of administering her estate. That person needs to understand the extent of the obligation to the mortgage company and the time frame they have to repay that mortgage. Our guest tonight will discuss reverse mortgage from both of these perspectives and provide a host of other suggestions he encourages you to keep in mind when considering and dealing with a reverse mortgage. With me today is a reverse mortgage professor from the American Advisors Group, where he has worked since 2012. Prior to that time, he was a manager of reverse mortgages with Wells Fargo Bank. He also teaches a course on reverse mortgages for the Howard County and Prince George's County Association of Realtors. Please welcome Bruce Winstead. Hi, Bruce.
Hi.
Thanks for coming by to talk with us about reverse mortgages.
Thank you.
Boy, this is something brings back memories, from when I first started practicing that it first came on the landscape, many years ago. So I guess the first thing is tell us a little bit about what is the purpose behind a reverse mortgage?
Well, the first thing I think we might want to mention is a lot of people have a lot of misconceptions and myths about reverse mortgages. The true purpose of it is it allows people that the youngest person on title has to be at least 62 years old. They do have a non-borrowing spouse agreement now so that somebody younger could be on title. And what it does is it allows people that are in that age group to start tapping into the equity of their home and use it for retirement. That's basically the purpose.
Okay, and so how does a reverse mortgage actually work?
Well, to make it really simple, they have qualifications for people to make them able to do a reverse mortgage.
Mm-hmm.
They'd have to be at least 62.
Right.
And then they take three things. They take the age of the borrower, the value of the home, and the interest rate. And those three things determine exactly how much money is available. And out of that money that's available, they have to pay off any existing liens on the home, so they do not have to own the home free and clear. They could use that money to pay off, they have to use that money to pay off any existing liens, and then what's left over is theirs to use however they want.
So how long have these types of mortgages been around?
Well, I think it was 1965 when they first came about. And the way that happened was there was some lady that was living in France, and her attorney talked to her about selling her home because she was struggling on paying her bills and everything. Mm-hmm. So he told her he would buy her home from her and then pay her every month a certain amount of money that she needed to supplement her income, and she could stay in the home until she passed away. And then she could pay him back by selling the home back. Well, he's already bought the home, but he could cash in by selling the home, and that's how it all came about.
Interesting. So who are good candidates for a reverse mortgage?
A good candidate is somebody who's in that age group, mm-hmm. who might be struggling to pay their bills. They might be behind on their not on their mortgage payment, but they might have a lot of car payments, or they might have a lot of credit card debts, mm-hmm. or they might just be struggling to make ends meet. They might be struggling to, go to the grocery store and buy their groceries or get medicines, and on and on and on. Financially, they're struggling. And what it does is it frees up some cash so they're able to enjoy their retirement.
Okay, well, good. Well, you mentioned in the beginning some of the eligibility requirements. Let's take a look at that. So, what are the eligibility criteria for a reverse mortgage?
Well, like I just said, they have to be 62. They have to own the home. They don't have to own the home free and clear, and that makes them eligible for a reverse mortgage. They can have a mortgage of their home that can be paid off by the proceeds. So, that's basically the person that's eligible to do a reverse mortgage. They'd have to be in that age group and have to have some equity in their home.
So you mentioned that the minimum age of the borrower has to be 62. Do both spouses have to be 62?
Well, they have what's called a non-borrowing spouse agreement now.
Okay.
It used to be when one person was 62 and the other person was in their 50s, they could do the reverse mortgage, but at the end of the loan, when the loan became due, when that person who was actually on the loan, the older person, passed away, the amount that was owed on the reverse mortgage would become due, and that person who wasn't of age at time of application is now, elderly person. They'd have to come up with the money to pay that loan off, or they couldn't stay in the property.
Oh, wow.
So now what they do is legislation came in, and they said that you can have a non-borrowing spouse agreement at time of application. So if that person isn't of age when the application's done, when it's all said and done at the end, they do not have to worry about paying it off. They can still stay in the home, but it freezes the assets. In other words, they can't keep drawing from the line of credit or anything like that.
I see. Okay. So, so let's talk a little bit about, are there any conditions that can be imposed in order to get a loan approval? Okay, in other words, if someone has bad credit, for instance, would there be any conditions that they might impose in order to approve a reverse mortgage?
Well, I think one of the major problems that people have read in the news is foreclosures. And the reason foreclosures are happening is because people didn't bother to pay their taxes and their insurance like any other loan. And I think the seniors weren't used to paying taxes and insurance because when they were paying the regular mortgage, it was included in it.
Gotcha.
So they didn't have the mind frame. And so then when they did the reverse mortgage, they just didn't either not bother to pay their taxes and insurance or whatever.
So I guess one of the things I know we talked about in the course of preparing for this program is that one of the obligations might be to actually require an escrow put aside for taxes and insurance to cover that for a while. If someone had bad credit, for instance, or maybe some sort of letter of credit to make sure they have the money to actually pay those taxes and insurance.
That's true, and what they do is they have a financial assessment in place now, but we have to pull their credit report. We look at their credit. If they have any derogatory credits that shows up on their credit report, we'd have to put a lease account set aside.
Okay.
And that's life expectancy set aside amount, and we put amount aside so that we can take care of paying their taxes and insurance.
Okay.
And sometimes it's to the point where if they have that lease set up and they don't qualify for the loan because they don't have enough equity in their home because the lease account is so much, they might not qualify for the loan.
Okay. Okay. Well, let's talk about the loan amount and payment options, okay, as we sort of begin to get into the meat of a reverse mortgage. What is the principal amount that can be borrowed on a
Okay, that depends on those three things I mentioned. Number one is their age. The older they are, more money they can borrow.
Okay.
Number two is the value of the home.
Okay.
And of course, if the value goes up, they can borrow more money. And then the third thing is the interest rate, the prevailing interest rate.
Okay.
If the interest rate is low, the lower the interest rate, the more money they can borrow.
Okay.
So they take those three factors, we plug it into a computer, and it'll mathematically calculate out what's called the principal limit. And that's how much money is available to them, subtracting out the closing costs.
Okay.
So there is closing costs with these loans that's financed into the loan. They don't have to come out of pocket with it.
We'll come back and talk about that, I think, in a little bit. But so is the amount borrowed a fixed amount, or can the loan be set up as a line of credit?
Well, there's quite a few options. They could either take it in a lump sum, which is the full amount. They can take that, and the interest that will be accruing on the life of the loan is accruing on that full amount.
Okay.
They can do a partial amount, and then they can also put in a line, set it up in a line of credit. If they take a fixed rate, they have to take the full amount.
Okay.
If they take a adjustable rate, they can set it up in different programs where they might need $10,000 or $15,000 to make repairs on their home, and they've only spent that $10,000 or $15,000. The rest of it can go in a line of credit and can work for them because it will grow. The line of credit will grow, which will give them more access to more money later on in the loan process.
And my line of credit grows because of why?
It just grows because it's sitting there and it's accruing interest.
I see. Okay.
And the interest that it's accruing, it's really not an investment type of money that grows. It means there's more access to the equity because hopefully the home's going to go up in value.
I see. Okay.
And it gives them more money that's available later on.
How is the interest rate determined?
It's the index they're using now is the LIBOR rate,
Okay.
which is a very stable index. So they take the margin, which is what the lender puts on it, and then the index and the margin is the rate. And then they have two kinds of rate. They have the initial rate and the expected rate. The initial rate is the rate that goes for the whole life of the loan that's accruing on the loan on the amount of money they borrow. The expected rate is one rate that you see at time of application, and that's locked in, and that determines how much money they get. Remember I mentioned the age, value, and interest rate? That's the expected rate.
Okay. Okay. So we talked about that, again, the interest rate can be fixed. It will be fixed if they take the full amount of the loan, and if they take a line of credit, then the rate will be variable. Got that. So tell me, once I've borrowed money, are any payments due on the amount borrowed?
When the loan is over, the way it works is, let's just say they had a home that was worth $400,000. They put the age, value, and interest rate in, and they get $200,000 that's available to them on the loan. The interest accrues on that $200,000 if they spent the full amount.
Right.
At the end of the loan, the heirs have a choice. They can come in and they can sell. The heirs aren't liable for the money at the end of the loan. The home is. So they have a choice. They can come in and sell the home, pay off what was spent on the reverse mortgage, and they get to keep the profit.
So let's talk about while I'm living. Okay, I've borrowed the money. Do I have to make any payments on the money I've loaned?
There's no payments on the money that's borrowed till the end of the loan.
Okay, so we don't have to worry about that until the homeowners actually die.
That's correct, and you also don't pay taxes on the proceeds.
Okay, so what we do have to do though, let's talk about cost. Okay, so let's turn to that cost of getting the loan. So, what are the costs to obtain a reverse mortgage?
They used to be really high. They used to be very expensive. So the government came in and regulated it. And what they did is there's three main costs in your closing costs.
Okay.
One's the origination fee.
Okay.
One's the mortgage insurance, and the other one is all the other fees: the transfer tax, stamps, documentaries, recordings fees. So the origination fee, it's 2% of the first $200,000, and then 1% after that, up to a max of $6,000.
Okay, so can the origination fee be negotiated?
It can.
Okay, so that's something to consider.
And that depends on, what the rate is and all of those different things. Or, of course, a lender can negotiate that origination fee, but that's how the lender makes his money, on the origination fee. Sure. But of course, it can be negotiated.
And is mortgage insurance required?
Mortgage insurance is required on all the loans, and that's 2% of the appraised value of the home.
That's a one-time cost.
That's a one-time. Well, it's a one-time cost, but plus it's a 0.5%. On the interest rate, it's included in the interest rate.
Okay, so the cost for the mortgage insurance is an additional component of the interest rate.
Correct.
Gotcha.
Of the 0.5%.
And so I assume that there are normal recording costs, to go to record, title insurance, and all that kind of stuff. That's an additional cost.
Which is pretty much the same as any regular home,
Sure, of course.
refinance loan.
There's a bunch of fees here. So do any of these fees need to be paid at closing?
They could be. They have the option to do that.
Okay.
But most of the time, they finance it into the loan.
Okay.
And they also have an option to pay down this loan at any time. There's no prepayment penalty on the loan.
Okay, that's good to know too. Okay, so let's talk a little bit, turn our attention now to the risk of reverse mortgages. So tell me, what are the risks of a reverse mortgage?
Well, it's a non-recourse loan. So there's the only risk on the loan is for the property. The property is when you do the loan, the property, the only liability in the loan is the property. The banks aren't liable, the lender's not liable, nobody's liable with the property. And what that means is, if you take a reverse mortgage out and you have a certain amount of money and then it becomes due and you owe more than the home is worth, it's a non-recourse loan, so you will never owe more than the home is worth, and they can't go after your estate for the difference.
So while I'm living and I'm in the house, the only way that I can actually lose the house is How?
If you don't pay your taxes and insurance.
Okay, so that's the key thing. The one thing you do have to continue to pay as the owner of the property that has a reverse mortgage, you've got to pay the property taxes
And the homeowner's
and
insurance.
you've got to pay the homeowner's insurance. And if you don't pay that, you're going to trigger a default under the loan document.
Just like a regular loan.
Okay. All right, let's switch gears now and talk about, we talked about risks, let's talk about benefits of reverse mortgages. So what are the benefits of a reverse mortgage? And I know you've talked a little bit about that, but let's just focus on that. So I guess one of the big benefits is that if I outlive what is considered to be the life expectancy of the loan when it's actually done, I get to continue to live in the property, right?
They cannot kick you out of the property as long as you're paying your taxes and insurance.
And then when I die, as you said, the property is a non-recourse loan.
Yes.
So explain again what that means for people.
A non-recourse loans means that you will never owe more than the home is worth. So at the end of it, let's say you're in a market like, remember when the market crashed and all the values of homes went down in 2006? Let's say you had a reverse mortgage during that time. And then you were in an area that was really a depressed area and the value of homes didn't go up at all. And let's say you lived to be 100 years old. So, and you took the full amount. So the interest was accruing on the full amount. So that at the end of the loan, your estate, after you passed away, your estate would actually owe more than the home is worth. They don't have to pay that difference. FHA insurance comes in and pays the difference.
Good
and
to know.
so that's why they're not liable.
That's good to know. Well, looking at the clock, we have a bunch more things to talk about. But let's just talk real quickly. You can't just walk into some local store, local office, and get and make an application for a reverse mortgage. As we talked about, there are a bunch of steps you got to go through. One of which is you guys should go through some counseling and get some information, right, from an independent independent group. Is that right?
That's right, and the counseling was set up for that reason. So it was really set up to protect the consumer.
Okay.
And the government stepped in and said, okay, we're going to have all these people that are registered as you know, to do the counseling. So you have all these companies out there that do the counseling. We have to give a list of those companies to the consumer, and then they call one of those numbers and they set up counseling. And the main reason for the counseling is to know that everything we told them as the loan officer and our company told them was actually the truth. Because, you know, they don't know us and it could be somebody in there taking advantage of them. And they want to make sure that these people know what they're doing when they get into the loan.
That's very important.
So it's a consumer safeguard.
Awesome. It's actually very important. Let's switch gears and talk about basically long-term care planning strategies that come into play with the use of reverse mortgages. So will a reverse mortgage have any tax or Social Security or public benefit consequences?
No.
Okay.
The only thing is Medicaid. If you're taking money out on and you're on Medicaid, where you don't have a certain amount of income, it could affect that.
Okay.
It does not affect Social Security and it does not affect Medicare. And when you fill out your taxes at the end of the year, it's like it didn't even exist.
Which is like borrowing money, right? So it's not an income consequence, of course. Now, we talked about long-term care long-term strategies. So I guess the thing is you can use a reverse mortgage, given the various options for how you can receive your money, to help supplement or fit into whatever your plan is for long-term care, as far as, you know, living out your life in your home or going into a nursing home or whatever.
That's correct.
Is that correct?
Well, actually, you can use the amount of money that's available to you on a reverse mortgage. You can use it for anything you want. And if you want to set it up where you do a term payment where you're getting a couple of $1,000 a month to pay for that long-term care, to free up the cash to do that, you can do that.
That's good. And then when somebody dies who has a reverse mortgage on their house, the last property owner dies, okay, at that point in time, I gather from our conversation, then the administrator or personal representative executor has 6 months to get the property sold typically. They can get some extensions. They can get up to 2-3 month extensions, so they could go out as much as a year.
As much as a year, that's right.
And the key thing, I guess, is to remember is that when, as a personal representative or an executor, that when the property is the most that the mortgage company can recover is the outstanding balance of the loan, or what the proceeds from the sale of the property, whatever is less.
Correct.
Okay, so they're never going to owe more than what the property will sell for. They could owe less if you owe less money.
Yeah, and most of the time when it comes to the end, the property is sold and the reverse mortgage is maybe 75% or 50% of what the property's worth, and the heirs end up with getting, a pretty good profit out of it at the end. That's what you want to see happen. You want to see the value of the home going up as the loan balance goes up, and hopefully it will not be to the point where it gets upside down.
Okay. Now, something you mentioned in the course of preparing, we talked about using reverse mortgages to actually purchase a home, because we've been talking in terms of refinancing, if you would, or doing a new loan for a house you already own. So talk about how that can occur.
Well, I explained to you the qualifications of how to do a reverse mortgage based on your age, value, and interest rate. The same thing applies when you purchase a home. It used to be you'd have to do a refinance on the existing home, purchase the home, and then do another refinance with a reverse mortgage on the new home.
Oh my goodness.
So now what they've done is they've made it one transaction. And in that one transaction, you look at the new home, you look at the price of the new home, the sales price, or the appraised value of that home. And that's the value. Then you take the age of the borrower and the interest rate, and you use that same formula to mathematically calculate how much is available on the new home.
Okay.
And then whatever is available out of that new home, you have to come up with the difference on a down payment.
Sure.
So if you found a home that was worth $300,000, the only way to buy that home and not have a mortgage payment is to bring $300,000 to the table.
Right.
If you do a reverse for purchase, that same home for $300,000, put your age, value, and interest rate in. Let's say you have $150 on that loan. That means you bring $150 to the table instead of the $300. We bring the other $150 to the table for the loan with no payments on for the rest of your life, and then you own a brand new home with no payments for the rest of your life. And then the other $150 that you didn't need to use is part of your retirement that you can use for other things.
Okay, that sounds like and I guess this is becoming a more popular technique for people to use as they move out of their older homes and want to relocate to different parts of the country.
It's very popular now.
Okay, excellent.
And it's called a HECM for purchase, HECM, which stands for Home Equity Conversion Mortgage. So if people out there see that, that's what it is. It's
that's the acronym.
Yeah, for reverse mortgage.
HECM,
Yeah.
Home Equity Conversion Mortgage. Very interesting. I think it's an excellent tool. Well, Bruce, this has been very, very interesting. You've been doing this for many, many years, so I thought maybe you might take a moment to go ahead and just kind of pick up some things you might want to really point out to folks, some closing comments about reverse mortgages.
Well, the one thing I'd like to mention is people even now are afraid of reverse mortgages because they think it's a scam. But it's not. What it is it's a tool, it's another tool for people like yourself or anybody who's helping people with the retirement portfolio to use these proceeds to be part of your retirement. And so I think that's a really win-win for everybody. The other thing of it being a non-recourse loan is a win-win. That nobody's really liable for it except for the home. A lot of times the kids will want a big inheritance and they got to realize up front, and that's one thing that's really important with reverse mortgages, is you have somebody come to your home and who will meet your family and talk to your family and show them all the pros and cons while they're going through the process. And so there's a lot of questions. As you can see, there's a lot of information in this hour we've been talking. But this is, people will ask, there's so much out there that's misrepresented and misinformed so that people are afraid to do it. So if you don't remember anything I told you today, there's 4 consumer safeguards that are really important. One is you never lose title to the home. As long as you pay your taxes and insurance, you keep your home up to standard.
Okay.
Number 2, you will never owe more than the home is worth, that we discussed. Number 3, you never have to make a mortgage payment for the rest of your life. There's no payments on this. And number 4 is they can't force you out of the home. You do not have to move as long as you're doing, taking care of those obligations.
Okay.
So I think that's really important. You want me to give you an example of something I did that really helped somebody?
Well, I think we probably will want to leave that for another time.
All
But
right.
I thank you for that offer. I want to thank you for taking the time to talk with us about reverse mortgages and helping explain it to me as we prepared for the show, and then for our viewers during the course of the show. It's been extraordinarily helpful, and on behalf of both myself and all the viewers on the Probate Nation, I want to thank you for doing that.
You're very welcome.
More and more seniors want to age in their home rather than head off to senior housing, assisted living, or a nursing home. A reverse mortgage is an incredibly important tool that may be just what is needed to allow you, a conservator or guardian of property, to keep a senior citizen in their home a bit longer. This tool, has undergone many changes since it was first offered many years ago. Some key points about reverse mortgages today that I take away from our show this evening are: there is no mortgage payment each month, but there is an obligation to pay the property taxes and insurance. After the property owner passes away, her estate typically has up to 1 year to sell the property and pay off the reverse mortgage. But the loan itself is a non-recourse loan, and this means the repayment obligation of the estate is limited to the lesser of the note balance of what the house sells for, nothing more. And most importantly, no application for this type of mortgage can be processed without being educated by a licensed independent agency on all aspects of this type of mortgage. Clearly, reverse mortgages are an important tool available to seniors, to their advisors, and especially their conservators and guardians of property. And with so many seniors seeking to age in place in the home they know and love, this may be just a tool to allow them to do so. This concludes our show this evening. We hope you found it informative. Replays of this show and all the shows to date, along with other helpful information, are available on the Probate Nation website. We encourage you to take advantage of this public service resource. On behalf of the Probate Nation, thank you for visiting with us.